Hello, my name is Franklin Castillo. In this lecture, we'll go over Chapter 12 from your Macroeconomics textbook. We'll be discussing money, banking, and the Federal Reserve. In this chapter, we'll discuss the process of money creation and the role of the Federal Reserve. First, we'll explain how banks create money through the process of accepting deposits and issuing loans. Then, we'll explore how fractional reserve banking enables banks to lend out more than the initial deposits that they receive. We'll also introduce the concept of the money multiplier and discuss what determines its size. After that, we'll examine the history and structure of the Federal Reserve System. Next, we'll take a look at the key functions performed by the Federal Reserve regional banks and branches. After that, we'll describe the main tools that the Federal Reserve uses to implement monetary policy. We'll also analyze the significance of the federal funds rate and how it influences other interest rates. And finally, we'll consider why the Federal Reserve's actions do not immediately affect the economy, which touches on the concept of monetary policy lags. When people think about money being created, they often picture government printing presses producing paper bills or a mint stamping coins. While that is one form of money creation, it actually represents only a small part of the total money supply. In today's economy, most money exists not as physical currency, but as digital entries, which are electronic debits and credits in bank accounts. For example, wages are typically deposited directly into bank accounts, and day-to-day transactions are often made with debit or credit cards. Because of this, money creation involves more than printing bills. It includes the role that banks play in expanding the money supply through the financial system. Let's look more closely at how money is created in the modern banking system. Bank deposits have broader economic implications than merely increasing the size of your checking account. Deposits are both a liability for the bank because they owe you that money, but also these deposits are assets for the bank since they can use a portion of those deposits to issue out loans. The portion that the bank does not lend out is therefore kept in reserves. The lent amount is then deposited into borrowers' bank accounts, increasing the money supply as a result. In other words, by lending out a portion of the deposits that they hold, banks effectively create money. As you can imagine, banks cannot lend endlessly. They must retain a portion of deposits as reserves to meet withdrawal demands. This fraction is therefore called the reserve ratio. Government regulators may also impose a minimum amount that banks must hold, which we call a reserve requirement. This entire process of multiplying the money supply through a chain of transactions reflects the workings of the fractional reserve banking system, where loans create new deposits and those deposits can in turn support more lending. To reiterate, in a fractional reserve banking system, banks lend out most of the money that they receive in deposits, holding only a fraction in reserve. For example, if you deposit $1,000 into your checking account, the bank might lend that same $1,000 to a local business. While it may seem that your funds are no longer available, the bank relies on the fact that not all depositors will withdraw their money at once. This is what allows banks to function smoothly even while making loans with deposited funds. Things like bank runs, where many customers try to withdraw their money simultaneously, are rare in the United States thanks to protections like the FDIC and the insurance that it provides, which covers deposits of up to $250,000 per depositor per insured bank. If a bank fails, the FDIC ensures continuity by arranging for a stronger bank to absorb its operations. The key idea is that banks only hold a portion of deposits in reserve, either as vault cash or as deposits with the Federal Reserve. This system allows for the expansion of the money supply as each loan becomes a new deposit that can fuel further lending. We'll explore the Federal Reserve's role in more detail later, but for now, this framework explains how banks play a central role in money creation. In addition to our $1,000 deposit, the bank will also have a reserve requirement. Let's put this, in this case, to be 20%. The bank will then set aside $200 and loan out the remaining $800. The deposits in this case are both a liability for the bank as it owes the depositors that $1,000 on demand, as well as a liability since the $200 are held in reserve and $800 are loaned out. These reserves, therefore, provide liquidity while the loans generate interest income. This transaction reflects the core mechanism of money creation. The $800 that are loaned out will likely be spent and redeposited either at the same bank or at a different one, where part of it will again be kept in reserve. And likewise, the rest will be loaned out. Throughout this repeating cycle, a single deposit can expand into a much larger amount of money circulating in the economy. Carrying on from the previous example, Bank A loaned out $800 to another business, and then that business went on to pay a subcontractor who then deposited the $800 into its own bank, which we'll call Bank B. The deposit becomes a new liability for Bank B while the bank gains $800 in assets. Following that same reserve policy, the bank holds 20% or $160, which are held in reserves, and then loans out the remaining $640. This cycle of deposits and loans continues with each new bank holding a portion in reserves and lending the rest. Over time, the entire original $1,000 becomes fully distributed as reserves across the banking system, even though it supports a much larger amount in total deposits and loans. Through the process of repeated lending and depositing, banks can create a total money supply that far exceeds the original deposit. For example, for every bank that lends out 80% of its deposits, meaning that it holds 20% in reserves, an initial $1,000 deposit can ultimately support up to $5,000 in total deposits across the entire banking system. This includes $4,000 in loans and $1,000 in reserves. The ratio of the total money created to the original deposit is called the money multiplier, and in this case it is 5. That multiplier is derived by dividing 1 by the reserve ratio, which in this case is 1 divided by 0.2, which equals 5. The monetary base is defined as the sum of all currency in circulation and the reserves held in banks, either in their vaults or on deposit with the Federal Reserve. This base forms the foundation for the broader money supply and plays a critical role in determining how much money banks can create through lending. We can see how bank deposits, when combined with banks' fractional reserve ratios, create money by a factor known as the money multiplier. More precisely, the money multiplier measures the increase in the money supply in response to a change in the monetary base, which consists of currency in circulation and bank reserves. In theory, the multiplier is equal to the inverse of the reserve ratio. However, in practice, the actual money multiplier, which is calculated as the change in the money supply divided by the change in the monetary base, is often lower. This is because factors like excess reserves and cash holdings reduce the overall expansion of money. Together, these relationships show how reserve policies and banking behavior influence the total amount of money circulating in the economy. In this simplified example, we assume that banks hold 10 cents in reserves for every dollar deposited and that consumers held no cash. Under these assumptions, the money multiplier equals 10 because 1 divided by the reserve ratio, which is 0.1, yields 10. This means that a $100 deposit ultimately supports up to $1,000 in total deposits across the banking system. If banks instead held only 5% of deposits in reserve, then the money multiplier would increase to 20. This illustrates how a lower reserve ratio increases the banking system's capacity to create money through lending. So in reality, as we already alluded to, the money multiplier is much smaller than 5. In fact, in the United States, the money multiplier is not much higher than 1. And the reason for this is because there is a tremendous amount of currency in circulation, such as cash held by individuals, businesses, and foreign entities, as well as reserves held by banks. When individuals or businesses choose to hold on to money as cash rather than depositing it into a bank, that cash is effectively removed from the loanable funds within the banking system. Because cash held outside of banks cannot be loaned out, it reduces the total amount of money that can be created through the process of fractional reserve banking. As a result of this, the money multiplier declines, and this therefore highlights the importance of deposit behavior in determining how effectively the banking system may expand the money supply. Currency stays in circulation for several reasons. First, banks keep cash on hand and in their vaults and ATMs to meet withdrawal demands. People and businesses also hold cash for everyday transactions where electronic payments are impractical. And also, a significant amount of US currency is held abroad by either foreign consumers, companies, and even governments, which takes it out of the domestic banking system and reduces its potential to support money creation through lending. When banks choose to hold more reserves than required, they're essentially insuring themselves against the risk of loan defaults. This is cautious behavior that protects them if borrowers fail to repay. Additionally, banks can earn interest by depositing their reserves at a Federal Reserve Bank. While this may seem like a sound strategy, it does have a side effect as it increases the monetary base without increasing lending. As a result of this, less money circulates throughout the economy, which lowers the money multiplier. Looking at a more realistic scenario, suppose that banks on average hold 25% of deposits as reserves, as an additional 15% of money exists as physical currency in circulation. This means that only 60% of the money supply is available for lending and redispositioning. Under these conditions, the money multiplier equals 2.5. This is calculated by dividing 1 by the sum of the reserve ratio and the currency ratio, which is 0.25 and 0.15. The result highlights how holding more money in terms of cash or higher reserves significantly limits the ability of the banking system to expand the money supply. The Federal Reserve System is the central bank of the United States, and it holds a unique power. That is the ability to create money within the economy. Its creation in 1913 followed decades of instability marked by recurring bank panics. After the bank crisis of 1907, Congress formed the National Monetary Commission to study reform options. Although the commission initially recommended a single powerful central bank, political resistance led to a compromise. The result was the Federal Reserve Act of 1913, which created a decentralized system of regional banks under a central authority. The act gave the Fed broad responsibilities such as issuing an elastic currency, rediscounting commercial paper, and strengthening oversight of the banking system. Over time, additional legislation such as the Employment Act of 1946 and the Full Employment and Balanced Growth Act of 1978 expanded the Fed's mission. These acts tasked it with promoting full employment, stable prices, and moderate long-term interest rates. Balancing all of these objectives simultaneously is a persistent challenge in economic policy. Nonetheless, these mandates define the Fed's role in stabilizing and guiding the national economy. The Federal Reserve is often described as an independent central bank. That means that its day-to-day operations and decisions are not under the control of the executive branch. Despite this independence, the Fed remains accountable to Congress, which holds constitutional authority over monetary policy. Through the Federal Reserve Act, Congress delegates that authority to the Federal Reserve, but retains the right to oversee its performance. Over the years, presidents have occasionally disagreed with the Fed's actions, especially during economic downturns, but the Fed has maintained its operational independence. This independence is not just a bureaucratic detail, it is something with real implications for economic stability. Evidence from the US and other countries shows that central banks with more independence are generally better at controlling inflation. That's largely because they can resist the temptation to overuse expansionary policies for short-term political gains, such as boosting employment or growth right before an election. By insulating monetary policy from these pressures, the Federal Reserve can focus on long-term economic health. The Federal Reserve was designed to be both centralized and regionally responsive. The Federal Reserve Act established the Board of Governors as the central authority of the Federal Reserve. It's located in Washington, D.C., and is responsible for overseeing the entire system, ensuring that there is consistency in policy and coordination across the different districts of the Federal Reserve regional banks. The board consists of 7 members, each appointed by the president and confirmed by the Senate to serve a single non-renewable term of 14 years. These terms are staggered so that one expires every 2 years, ensuring continuity and reducing political influence. While the board was traditionally filled by academic economists, recent appointments have included professionals from legal and financial backgrounds. The chair and vice chair are chosen from among the 7 of the board members and serve 4-year terms, which are renewable as long as they remain on the board. With a staff of about 2,000 people, the board plays a central role in shaping monetary policy and regulating the banking system. The Federal Reserve Act also established the 12 regional Federal Reserve banks, each serving a specific district across the United States. These regional banks gather local economic data and perspectives, which are crucial for shaping national monetary policy. This structure allows the Fed to respond to both local conditions and national economic trends. The Federal Open Market Committee, or FOMC, is another component of the Federal Reserve, and it is responsible for setting the nation's monetary policy, particularly by targeting interest rates, and is made up of 5 of the 12 regional bank presidents, with the president of the New York Fed being a permanent member. This map shows the 12 regional Federal Reserve districts, each with their own regional reserve bank. These districts make up the Federal Reserve System and are each responsible for implementing monetary policy, supervising banks, and providing financial services within their respective regions. The structure helps them to ensure a diverse regional perspectives and that each of these regions are represented in national economic policy decisions. One key responsibility of the 12 regional Federal Reserve banks is to issue currency. These notes are marked with a letter corresponding to their issuing regional reserve bank. In addition to distributing physical currency, the regional Federal Reserve banks operate a national payment system. They regulate and supervise member banks and also act as the fiscal agent of the U.S. Treasury. Beyond these operational duties, these banks also collect data on regional economic conditions. This information is then synthesized into what is called the Beige Book, which is published 8 times a year and informs both the Board of Governors and the Federal Open Market Committee on their monetary policy decisions. Through the Federal Open Market Committee, the Federal Reserve sets the nation's monetary policy, particularly by targeting interest rates. The committee meets roughly every 6 weeks to assess the state of the economy and announce any changes in monetary policy. Although all regional presidents attend, only the voting members cast formal decisions. The chair of the Board of Governors also serves as the FOMC chair. The federal funds rate is at the heart of how the Federal Reserve carries out monetary policy. This is the interest rate that banks charge each other for overnight loans of excess reserves. When a bank is short on reserves, say due to unexpected withdrawals, it can borrow from another bank with surplus reserves at this rate. By targeting a range for the federal funds rate, the Fed influences broader interest rates across the economy, which in turn affect inflation, investment, and employment. For example, in March 2022, the FOMC set the target range for the federal funds rate from 0.25% to 0.5%, using the various tools at its disposal to steer the actual rate onto that range. The Federal Reserve also plays a critical role as the lender of last resort, stepping in when banks face mass withdrawals and cannot meet the demands for cash. Due to fractional reserve banking, if panic sets in and too many people try to withdraw at once, banks risk becoming insolvent. In this case, they can quickly sell off their assets like loans or securities without incurring huge losses. That's where the Federal Reserve comes in. In times of crisis, like in 2008 or during the 2020 recession, the Federal Reserve provided emergency loans to keep the banking system afloat. In 2008 alone, it lent over $2 trillion and shifted its asset holdings from primarily being Treasury securities to riskier money-backed assets. Without this intervention, the economic damage from those recessions would have been even worse. This function, that is, backing the financial system in emergencies, is a key reason that the Federal Reserve exists. The Federal Reserve uses several tools to carry out monetary policy. One is the interest on reserve balances, or IORB, which is what the Fed pays to banks on the reserves that they hold. This helps to influence how much banks are willing to lend to each other. Another is the discount rate, which is the interest rate that the Fed charges to banks when they borrow directly from it. Then there are the open market operations, in which the Federal Reserve buys or sells government securities to influence liquidity in the financial system. Finally, the reserve requirement is the minimum fraction of deposits that banks must hold rather than to lend these out. While some tools like open market operations and the IORB rate are used frequently, others like the reserve requirement are rarely adjusted. In unusual times, however, the Fed may also use less conventional tools like quantitative easing or overnight reverse repurchase agreements to restabilize the economy. To adjust the federal funds rate, the Federal Reserve uses policy tools to guide the market rate towards its target. While the rate is set by supply and demand between banks, the Federal Reserve's influence is decisive. Before the 2008 financial crisis, the Fed managed the rate by adjusting the supply of reserves through open market operations. At that time, banks held only the minimum required reserves because the Fed did not pay interest on those deposits. Adding reserves lowered the rate, and removing them raised those rates. Open market operations were the main way that the Federal Reserve influenced interest rates. After the 2008 crisis, this system changed significantly. To stabilize the banking system, the Fed began paying interest on reserves held at the central bank, which gave banks a safe, risk-free place to store funds and reduce their incentive to lend excessively. As a result, reserves in the banking system surged from around $10 billion to over $2.8 trillion within a few years. By 2020, reserves exceeded $3 trillion. With such a large supply of reserves, small adjustments no longer moved the federal funds rate effectively. Therefore, the Fed shifted to relying mainly on administrative tools, especially the interest on reserve balances. This shift marked a fundamental change in how monetary policy was ultimately conducted. You can think of the interest on reserve balances rate as it is an administrative tool that sets the floor under the federal funds rate. The reason we say this is because no bank would lend to another bank for less than what it could earn risk-free by leaving its money at the Federal Reserve. Because of this, arbitrage keeps the federal funds rate closely aligned with the IORB rate. At the same time, the Fed uses the discount rate as a ceiling. The discount rate is what banks pay to borrow reserves directly from the Fed, so no bank would pay more than that in the federal funds market. Together, the IORB rate and the discount rate create a corridor that keeps the federal funds rate stable. Now, this interest gives the Federal Reserve much more precise control over interest rates, even in a banking environment flooded with reserves. However, while monetary policy remains powerful, it still faces implementation delays and other real-world limits, just like fiscal policy. This chart illustrates how the Federal Reserve approached monetary policy prior to the 2008 financial crisis. During this period, the Fed did not pay interest rate on bank reserves, so banks had little incentive to hold excess reserves at the Fed. Instead, they lent out as much as possible. Because reserves were relatively scarce, the Fed could effectively manage the federal funds rate through open market operations. When the Fed wanted to lower the rate, it bought government bonds, injecting reserves into the system, which increased the money supply and drove interest rates down. Conversely, to raise the rate, the Federal Reserve sold bonds, pulling reserves out of the banking system and causing rates to rise. This mechanism allowed the Federal Reserve to influence short-term interest rates with a high degree of precision simply by adjusting the volume of reserves in the banking system. Monetary policy, while powerful, does not work instantly. It is subject to four main lags that create delays between a policy decision and its economic impact. First, there are information lags. Economic data take time to gather and often arrive 1 to 3 months after the event occurs. On top of that, the data may be later revised, making it difficult to detect trends right away. Second, we face recognition lags. A single dip in GDP or inflation doesn't necessarily indicate a recession or overheating economic conditions. Policymakers must be cautious in distinguishing temporary fluctuations from genuine long-term changes. Third is the decision lag, where while financial policy involves lengthy legislative battles, the Federal Reserve meets frequently and can adjust and decide quickly. Compared to Congress, the Fed is very nimble, but even so, reaching a policy decision still takes time as members deliberate. And finally, there are implementation lags. So even after a policy is enacted, it takes time for banks, markets, businesses, and consumers to respond. Since interest rates are only one factor influencing economic behavior, the total lag between a monetary policy change and its full impact on the economy can range from 1 year to 18 months. These lags make it very difficult for the Federal Reserve to time its actions precisely. And when the federal funds rate is near zero, as it was during 2008, traditional tools lose their effectiveness. That's when the Federal Reserve turns to alternatives like purchasing mortgage-backed securities and launching quantitative easing to inject liquidity into the economy. While we can debate the success of these interventions, one fact is clear, and that is that the Federal Reserve's ability to adjust interest rates and manage the money supply remains a central force in steering the U.S. economy. We will end this chapter with a profile on Janet Yellen, who is certainly a landmark figure in American economic history. She is the only person to have led the Council of Economic Advisors in the Executive Office of the President, the Federal Reserve, and the Treasury Department. After earning her PhD in economics from Yale, she taught at Harvard and later joined the Federal Reserve. Her work emphasized how monetary policy affects the economy through sticky prices and wages, strengthening the case for Keynesian ideas. Yellen's career is defined by academic rigor and leadership during major economic challenges. This concludes my lecture. As always, feel free to reach out with your questions, comments, or concerns. Thank you for watching, and have a good day.